There's a company we know that raised $5 million and they were less than a year in business and all the founders were making $250,000 a year. And that company in less than a year shut down and burned the money. Can I share a term I've coined? The unicorn whirlpool, where you can get stuck on the unicorn path and be sucked into a vortex or a whirlpool, and it can really destroy your company. Tyler and I frequently meet with entrepreneurs who raised a boatload of money too early, having to grow into their valuation. Didn't happen. The board with all these investors on it makes them do weird things, even sometimes fires the founder as the CEO, and the company just goes into a death spiral.
Welcome back to the Startup Ignition podcast. We are so excited to be holding this episode today. It's turning really cold in Utah, so we are bundled quite up, and we are in the middle of December here. And I'm your host, Tyler Richards, and I am with my co-host, my partner, my dad, and what else? My personal startup mentor, and many other things, John Richards. And today we are very excited to talk about a couple of startup topics, mostly within the pre-seed realm, because we have no guest today. It'll just be me and John talking shop about venture, about startups, and about what we're seeing in the market. So,
and we are the Startup Ignition podcast. I'm not sure you said that.
Okay, yeah. Welcome back to the Startup Ignition podcast. There we go. There's the line. But before we get into the data and before we get into charts and what we're going to talk about today, I want to loosen things up and get into an icebreaker that I'm going to do with my dad here.
You're going to spring it on me.
Yeah, okay. We're going to do something that he doesn't know about, but we are going to do a fill in the blank today. Okay. So I'm going to give you 5 to 7 scenarios and or lines, and I want you to fill in the blank. Okay.
Yep.
You ready? Mm-hmm. Here we go. We're going to go through them quickly. The fastest way for a founder to lose a $500,000 pre-seed round is blank.
So once they've got the money, how they burn it. Okay, the fastest way to lose a $500,000 pre-seed round is to start building your product and hiring lots of tech people, and or premature marketing where you start making collateral, have a marketing person trying to spend money to go to trade shows and do marketing, advertising, and you haven't found product market fit or done any testing.
So to summarize is scaling it, and then trying to nail it.
Premature scaling. But the two areas that burn the most money and where people lose it is starting to build product, tech, salaries and people, consultants and offshore people, dev shops, whatever. And the other thing is marketing when there's nothing to market.
Yeah. Okay. So premature scaling.
Yeah.
Okay. Here's another, number 2. A founder's superpower is actually blank.
A founder's superpower is actually understanding the customer that he is targeting. And he can walk up to a whiteboard and explain to you and me a day in the life of that customer and what his problems are, what he needs, and how his product is going to change their life for the better.
All the way up to what they eat for breakfast.
And just so superpower is
intimately knowing their customer.
Yeah, we'll call it founder market fit. They have a healthy obsession and they know their customer super, super well.
Yeah. Okay. Number 3, a pitch deck is not complete without blank.
A pitch deck is not complete without a go-to-market strategy laid out and say what investors, there's lots of stuff, problem, solution, size of market, team's really important, of course, too. But half of the pitch deck should be saying, here's how we're going to sell this and sell it well.
And really detailed, because I feel like a lot of founders just like superficially go over that and they're like, oh yeah, we're just going to pay an influencer to market our product.
Let's give you an example. Like, for instance, a lot of companies will come and say, oh yeah, we're going to go after the SMB market, small and medium businesses. Well, I have a lot of history of that. Going after the SMB market is extremely hard and needs lots of people, whether you have premise sales reps or telemarketing sales reps or however you reaching them or trying to do it through digital marketing, trying to go reach the millions and millions of SMBs. is a really hard undertaking, and we can't just have one slide say, hey, we're going to go after the S&B market. We go, how are you going to go after the S&B market? What is your plan? What are you going to do? How do you have any experience in doing this?
And that's because typically it's a huge market, and it's expensive to reach them because it's so big and there's so many of them. You have to have a huge sales force or a lot of marketing dollars to do that. And it's like, okay, we're not going to fund that kind of activity. You have to be more precise, more detailed in how you're actually going to efficiently reach them.
Let me tell you one other fun story that bothers me on this too, is just about when they say, oh, we're going after the enterprise market. So bigger companies, larger companies, we're going after the enterprise market. But then I ask them, okay, what validation have you done? And who have you gone and talked to? And they say, well, it's really hard to get in to talk to our target market. They're like director level VPs or C-level at big corporations. And they can't seem to find a way to get in to ask them if their idea is a good idea, if this product or service existed, would they be interested in it? What things can they learn from their target market? And so I go, okay, so hold on for a minute. You're saying it's really hard to get in and talk to them just
to validate?
Do they like it, to validate? But then they say their whole sales plan is they're going to get in to sell those people.
Yeah.
Okay. So I go, if you can't get in to validate, how are you ever going to get into sell?
Yeah.
Okay.
Yeah.
Anyway, that's just a funny thing that pops up.
So you
all
just
the time.
really, okay, to summarize number 3, a pitch deck is not complete without a go-to-market strategy and slide, because if you haven't worked through the steps and that journey, you're never going to be successful. You need to show us or any VC or any investor how you're actually going to reach the customer, capture the customer, sell the customer, right?
Yeah, it can't be superficial either. All the time when everything's looking good and I ask an investor, why didn't you invest in that? They go, I just did not believe that team convinced me that they could actually sell this.
And if your answer is we're just going to raise lots of money and just reach the market by spending marketing dollars, I mean, any big boy, any competitor that's already in the market can do that. Yeah. So you need to be a little bit more creative in that approach.
You will need so much money. If you're just going to buy customers, you need a lot of money. You have to have a product that sells itself and has a strong word of mouth. Yeah.
Okay, here we go. Now the inverse. If we could ban one slide, this is number 4. If we could ban one slide from all pitch decks forever, it would be blank.
One slide. Mm-hmm. One slide. Well, for me, my pet peeve is when they just spend too much time on the problem and the product. So it would be a superfluous slide that drones on too long about the solution and the product. Entrepreneurs are generally so in love with their solution and product because they've discovered this problem, they've devised a solution, and they think their product's all that. When, again, this is back to the last question, they spend so much time on those and not enough time on go-to-market.
Let me add to that. So I think what you're trying to get at is like going into the details of the problem and the solution and the product that's at hand. But what founders need to realize is that pitch decks are not, marketing collateral. We're not a customer of what you're pitching to us. We want to understand the business opportunity at hand, right? We want to know, okay, what have you found the problem solution, and what's the business model that you're going to be able to capture, deliver, and take to market to make money, right? So we're not a customer, we're an investor. And so don't hand us like a 10-slide deck of how great your product is, basically treating us like you're wanting to sell us as a customer. There's two different things there. And I think a lot of founders really make that mistake often.
Can I tell a great story?
Sure.
That's really quick. Okay, so there was a company called ClearPlay here in Utah, invented a DVD player that edited.
This is showing your age.
Yeah, edited movies on the fly. Okay.
Okay, interjection real quick. My kids don't even know what a DVD is. Okay. They don't even know what a DVD is.
Okay, DVD. Okay, I'm not going to explain that. But anyway, so they edited movies on the fly on a DVD, meaning taking out content that the parents or family wouldn't want in there for when their children watch a movie. So anyway, this DVD player was a great invention. And actually, I one time helped them get 22 millionaire investors into a room, and they spent 45 minutes on the problem and just defining the problem. And I go, come on, that's 60 seconds. Show a bad scene from a movie, play it on your DVD player that it's edited and cleaned up, and they'll be all over that and excited. And they took 45 minutes just saying, oh, Hollywood's bad. They put bad stuff in the movies. And so 11 of the 22 walked out, never even got to the solution or the pitch and the go-to-market. It was crazy.
Yeah.
And that they corrected that afterwards, but that's just mistakes entrepreneurs make.
Yeah. Yeah, because we get it. You're passionate. You're excited about the solution and the product and all the features, what you're going to do. But again, it's like that, like one slide done.
Investors see a lot of pitches, a lot of deals. They get problem, solution, product really fast.
Yeah. Yeah. But then again, if your solution and your problem is really complicated and you have to explain background to get to the problem or get to the solution, sure, that makes sense to spend a little bit more time. But make sure it's not a marketing pamphlet.
They should have backup slides for the Q&A session where they can get more in depth if that's what those investors want. Some investors do, some don't.
Yeah.
Okay.
Okay, last one. We are going to skip forward here because we're spending so much time on this, but I'm going to do one more, okay?
Oh, we're teaching in the way. It's good. Okay.
Okay. The moment we know a founder is going to be successful is when blank.
The moment we know a founder's going to be successful is when blank. Well, there's different times and different moments I can think
what's the first one that pops into your head?
When they start having revenue and sales. I mean, that's a great one. I don't know. That's
the one that popped into my head just now is when the founder is willing to almost do anything to see success. And what I mean by that is a lot of times we'll see founders coming in here that look at fundraising as a way to basically support their lifestyle or their living, which is great. Every founder, I'm not saying everybody needs to eat beans and sleep on a mattress, but I'm saying every dollar that you're paying yourself from your fundraise is taken away from the operations and the potential growth of the business. So I think when a founder is willing to say, yeah, I am going to pay myself $60K, $50K, $40K, because every dollar that I know that I'm saving from salary is going towards growth, marketing, product, whatever it may be. And I know those kind of founders have what it takes to be like, okay, when times get really tough, because times are going to get tough, then I know that founder is going to push through and stay with the startup and make sure they get over the hurdles. So what you're saying is, you
know that you've overcome one major hurdle, that they can clear the path to be on the path to success.
Yeah.
Right?
I just think that's really big.
They have high potential for success.
That's a huge characteristic of successful startups, and especially in the way that we're investing, we see. Because, we're not huge check writers, we're sub 1 million check writers, first checks into companies. And, again, that money can go really quick, but I see the biggest thing is usually salaries and HR.
Let's tell one for a story. We're not going to name the company or the investors, even though there's many of the investors.
Is this a bad example or a good example?
Yeah, I just want to say,
it's a bad example.
Let's look at the antithesis of this. There's a company we know that raised $5 million and they were less than a year in business, and all the founders were making $250,000 a year.
Yeah. Okay.
And that company in less than a year shut down, closed down, and burned the money. Yeah. That's crazy, but it happens.
And that can totally happen, because once you get a check from an investor, from us, from a VC, from anybody that's investing in your startup, you have the operational and the management power to do whatever you want with that check, unless a VC is going to be an ogre come in and say, here's your cap salary and here's what you can spend on yourself, or here's what you can spend on HR.
And there are those provisions in a lot of later stage, but in pre-seed,
that's not really typical. Not that much, right? And we try to be as founder friendly as possible. Like I think people are really shocked when they hear the setup and the terms and the things that we do and don't do that are very in favor of the founder. And so we just don't want to be in that kind of situation where we feel like the founder is going to pay themselves $250K the next day that we give them the check.
Well, now we got to tell them a couple of things that make us unique. Like one of the big unique things is we don't take a board seat.
Yeah. We had a phone call just yesterday about someone who was absolutely shocked that we don't take board seats.
Yeah. The bottom line is here, we believe that in the pre-seed realm, that it's your company. You're the expert on this. We aren't the expert. We don't want to run this company. And if we're investing in you, we trust you at the pre-seed level. I understand why a Series A investor wants a board seat, of course, but at pre-seed or an angel investment, a board seat, it's not needed.
And actually, to add to that, I feel like it actually hampers the progress and the growth of the company. Like if you have to have investor approval to do things,
or just feel like somebody's breathing that.
We don't want to be that.
We want a CEO who's in total control of his company and makes it happen. Anyway, that's our feeling.
Yep. All right. Thanks for playing my game. Yeah, that is the icebreaker for today. Just fill in the blank startup
I thought
edition.
they were good. If you got more, let's do a couple more. But
well, I want to get into the podcast today because we have a really long report that I'd like to go over that I think everybody in the audience and listening and watching will find really, really relevant to what they're doing.
That's the most recent report from PitchBook?
No, from Carta.
From Carta.
There is a PitchBook one.
Sorry, Carta.
Yeah. So today we're breaking down the state of pre-seed, Carta's brand new Q3 2025 data report.
Let's explain who Carta is and do a shout out to Carta.
Sure, go for it.
So Carta, his original name was eShares, if people don't know that from the .com era. But Carta is probably the largest back office for venture funds. If you're running a venture fund and you don't want to have a full staff, they'll be your back office. They also help companies, all sorts of companies, startups, whatever size, also manage their equity. So cap table management, stock certificate, digital stock certificates, the whole thing. They do a lot more things too. They have 401(a) valuations that are probably some of the best pricing in the business.
Yeah.
And so Carta does a lot of things, and our fund uses Carta for its back office.
Yep.
And so that's Carta. And so they see probably more than any other company the highest volume of deals and what's really happening on the inside. And then a macro way, they take that data and provide these reports.
Yeah. So it's really cool. They see all of these deals because they're literally managing those deals on their platform.
Yep.
And all the startups that are wanting to manage their cap table and these fundraisers and the equity within their startups, they're voluntarily putting it on their platform. So they say, hey, we have access to all this data. We have thousands of transaction level insights that we could compile and basically show thousands and thousands of deals happening and show what's happening in the market. So
let's get into it.
That's what we're going to go over today to see what's actually happening in the market, because I thought it was really insightful and really cool. So our goal today is to simply just decode the data, look at it and see what's going on, and give you guys a higher confidence level to feel what's happening in 2025 and as we roll into 2026. So here we go. So you can go to this report. It's really simple. Just go to carta.com /data/state of pre-seed Q3 2025 full report. Just go search that and Google that online. It'll be the first link that you find. And that's the report we're going to go over today. And this was released back on November 18th. So it's pretty relevant. But the first thing that I noticed that when we were going over this report was the very, very first graph. If you go to the very first graph, it says that pre-seed funding actually declined in Q3 2025 by cash raised and deal count. So Q3 dropped to 965 million from Q2's 1.19 billion and Q1's 1.21 billion. So deal count dropped from 6,548 deals to 5,660 deals.
And this is for the United States.
This is for the United States. So this is not a crash. I feel like it's just a seasonal correction, right? Like I feel like as we head into, you've always said this, as we head into fall and we head into holiday season, VCs just
that was third quarter, second quarter going to third quarter.
Yeah.
Yeah. There's an unwritten rule a little bit in VC, and that is August is vacation month. August is the month you travel with your kids and summer vacation for venture capitalists. So there's going to be less deals done in August, and fourth quarter is going to be the same way because it's that way from Thanksgiving to New Year's.
Yeah.
And so that I think plays a little into that.
So yeah, less deals were done, less cash was invested, but at the same time, I think 2025 is overall up from 2024. And
it better be.
No, it is.
I'm just saying, up until Election Day 2024, 2024 was looking pretty dismal.
Yeah. I just also think that founders need to stop like narrative chasing and just stick to fundamentals anyways. Like I don't find this.
Oh, by the way, you mean if you have a good deal, in other words, if you've got a great problem you discovered and you've devised a great solution, you validated it, and you have revenue and it's starting to grow, it doesn't matter what the economy's like, you're going to get funded?
Yeah.
Oh,
so
okay.
That's what I'm saying is just like, don't pay attention to like the macro economy's micro movements because it's not that impactful.
Yeah.
So, okay. And plus, you can't time the market. I think we've talked about this 100 million times. You don't know when it's going down. You don't know when it's going up. And by the time you're probably reading all this data, it's doing something different anyways. So, okay. Number two, And we discussed this. We talked about this, something that we saw, and this was on the graph of that there's a bifurcation. So there's in pre-seed specifically, that there's actually a ton of tiny rounds and a few monster ones, and not a whole lot in the middle going on anymore. And what kind of stands out to me is that under $1 million rounds are actually up, and plus $1 million rounds are slightly down, but over 40% of pre-seed rounds are actually under 250K.
Yeah. So basically, this speaks to an episode we did a while ago that's gotten us a lot of attention, which is unicorns versus elephants.
Yeah.
And it's really, a lot of people resonated to it. And spoiler alert, we are kind of elephant builders, not unicorn builders. And there's a lot of things. Also, can I share a term I've coined, which is the unicorn whirlpool, where you can get stuck on the unicorn path and be sucked into a vortex or a whirlpool, and it can really destroy your company. Tyler and I, all the time in the last 3 years, when I say all the time, frequently meet with entrepreneurs who raised a boatload of money too early, got cut in that whirlpool, having to grow into their valuation. Didn't happen. The board, with all these investors on it, makes them do weird things, even sometimes fires the founder as the CEO, and the company just goes into a death spiral. And it's happening. We see it all the time. They come to us wanting us to help save the company. That's not what we do in terms of investment. It's just, we'll mentor and help people through the situation. But yeah, it's tough. And that chasing unicorns is really tough. As a matter of fact, in prepping for our boot camp last week, I did some research, and it turns out that of all startups, you have about a 0.1% chance of making it through that process.
Yeah.
Very, very low.
No, it's small.
And so, but an elephant, where you keep control of your company, you grow revenues nicely, and you have an exit for a lot less valuation, but you own multiple times more of your own company by the time the exit, is a nice lifestyle and a nice outcome.
And actually obtainable.
Yeah. And the lifestyle for the 6 to 10 years you're doing that is nice compared to the go, get big, get fast, grow fast, raise money, and the pressure from the board of directors to perform and hit your numbers. It's just tough.
I think this kind of barbell market that this data
Bifurcation is. Yeah.
That's showing is that it's like you're raising these smaller rounds. 40% of all pre-seed rounds are under sub 250K, which means that these are kind of like realistic validation rounds. Like, as a pre-seed founder or as an early stage founder of a startup, the last thing you need to do is go raise millions of dollars on an idea that you don't have PMF or feel completely validated in, because if you do, you're going to waste that money and have nothing at the end of the day to show for it.
Let's share our experience with
I just think that the market is kind of realizing that if 40% of all pre-seed rounds are under 250K, I feel like founders are saying, okay, like, hey, if I'm not ready yet, it's the dumbest thing to go and act like I'm ready. The large
big funds have to deploy a lot of capital and they have to get huge returns. Matter of fact, one of those stories, the company that raised, well over 10 million, probably prematurely, took on debt from a bank on top of it. There was the largest investor that's on the board of directors told them right before the shutting down of the company, said, hey, even if this, sold for 350 million or even 750 million, we wouldn't consider that a good outcome.
Yeah.
And that's just unbelievable, right?
That's just so deflating for a founder. Hey, if this sold for 350 or 400 million, that wouldn't even be a win for us. It's like, what? So
it's just
hard
a different way to look at it. So yeah, I think it'd be really interesting to tell a couple stories from what we've seen, just to tell people what we're seeing out in the field. And that is, we have taught a lot of people that, for around, call it $400,000 to $600,000, you can get almost any software startup off the ground and create massive value on just that much money by using your ingenuity, lean startup methodologies, and doing things the right way. And it's just incredible the value that you can create doing that. And then there's people that don't buy into that and don't really care for that.
That's
path.
okay.
And then they go raise like $1.5 to $2 million. And then about 9 months later, when we're checking in, they've like squandered half that money and take a major pivot because their product market fit wasn't there.
Yeah, I think.
And we go, so you gave up all the equity to get 1.5, 2 million, you burn 1 million of it, and then all of a sudden you have to take a major pivot and almost start over again.
Yeah, I think just there's this massive shift because this sub 250K pre-seed, 45% of all pre-seed rounds is just really sticking out to me. And it's just a massive shift towards capital efficiency, which 5 years ago we were not seeing. We were seeing very inefficient capital and very inefficient fundraising. And so I like this. And that is the message that we give to most founders. But I want to cap your statement with, if they don't want to do that, that's fine. We don't want to force a strategy on them that they don't believe in. But our pattern recognition, I've been investing for 10 years. He's been investing for 25. Like, we've seen this game play out.
This is another one we do that we're a little different on. We give a term sheet and say, go tell others what our term sheet is and what the terms are we're doing, and shop it around. Okay. And guess what? If you get a better deal, fine. That VC or that investor has felt that. We gave you what we think you should do and what we feel the value is, and we will actually salute you and we'll take you to dinner.
Yeah, no, I just had this conversation on Tuesday at a large annual event that we usually do, and two brothers that came through our boot camp had an awesome idea. And we were so excited.
We were on the verge of a term sheet.
Yeah, we were so excited post boot camp after their cohort to get to a deal. And we kind of floated out terms of what we were thinking in the shape of the deal. And they were excited, but then they went and we said, hey, go and shop this around, because we don't want to be an impediment if you can go and get a better valuation or a better deal. And they did, and they went and got a better deal. And we reconnected on Tuesday post all of that. And he was like, hey, we're so thankful for everything you guys did.
We were instrumental in helping him get there.
Yeah, and I told them, hey, no hard feelings.
They told a lot of people.
Like, did we want to invest? Yeah, we wanted to invest. But if we didn't and you guys got a better deal, hey,
they told a lot of people at our annual meeting that if they hadn't gotten our mentoring, they probably wouldn't have been able to do that. That's what they said. And we'll have to see how it all turns out. But that's just, and we're super happy for them.
Yeah.
And they're great guys.
And you guys know who you are. So, yeah. Okay. So that's about the bifurcation, the barbell market. We're seeing small rounds, but then high conviction, bigger rounds, but there's been less of those. And so again, the market is shifting towards capital efficiency and like micro capital, which is really cool.
We'll have to see how it all turns out.
Yeah.
Right? Yep.
Okay. So the next one here is, how many checks does it really take? There's a graph, I think it's like the fourth graph on the report, that most pre-seed deals involve at least a few individual checks. Like, we're seeing more in the pre-seed, more.
Are you talking about checks or just separate investors?
Separate investors and checks to make up the round. So what stands out on this graph is under 250K, you're seeing on average about 3 investors commit to that 250K.
So they're doing 50, 75,000.
Yeah, they're doing like angel, rounds where you're getting multiple angels to come in. Then on a 500K to 1 million, it's about 4 investors that are committing to that. So the number actually raises the higher you get. And then as you go on, 1 million plus, it's 4 investors, 2.5 million plus, it's 5 investors, 5 million, it's 6 investors. So about every
that's what I would have guessed. Something like that. Yeah.
Yeah. So I'm just saying, kind of, founders overestimate how many investors that they actually need. Right. I feel like that happens a lot, but they underestimate how many conversations they have to get to that, to those 3, 4, 5, 6 commitments. So
hey, you're making me think of some tips we should share with those that don't even get into this kind of conversation.
Okay.
And how they could be careful. Because we have a lot of listeners that are entrepreneurs that, just don't run in these circles and maybe get the chance to even do this. But they need to raise that 150 to 250,000. So a couple tips that we'll give you is be very careful taking check sizes much under 25,000.
Yeah, for sure.
So like you take 5, 10, 15,000 from friends and family and different things like that. That will actually hurt you in the long run if you do become successful and have to get into the main path of venture capital ecosystem. Getting your cap table, the ownership structure full of a bunch of small investors, it's just not wise and doesn't play really well. But also a thing about, you can have non-accredited investors. What I mean by that is people that don't have $1 million net worth, not counting their home, of investable assets or whatever. You can all go look up the definition of accredited investor. But you're allowed, if you file for Reg D, to have a good number of unaccredited investors. But my advice is always don't take any unaccredited investors. It's just not worth it for the long haul. Maybe your father, your mother, a super close relative that's not accredited, you take a little bit of money as you do that first 100 to 250,000 or something like that. But taking any kind of arm's length person that's unaccredited for a small check is not gonna, the only thing that can happen there, nothing much good's gonna come from that, and a lot of bad can come from that.
So
does that make sense?
Yeah, and let me double underline this. You don't need 50 checks to fill a pre-seed round. Please do not do that, because that's a really common misconception. Most founders come out there and say, oh, I can just do 10 grand here, 5 grand here, 25 grand here. Like my dad was saying, that's going to really hurt the long run of your company and really mess up your cap table. So you don't need 50 checks to fill that pre-seed round. You need 1 to 3 to 5 good ones, and then you're solid. But you do, so don't overestimate how many checks you need. And don't underestimate how many conversations you have to have.
We could talk about this for the next 30 to 60 minutes on the good and bad and ugly that happens from all this and what could happen. We don't have time.
Oh yeah, but one more thing I want to double underline is, like, a lot of founders think that they can go talk to 5 to 10 people and get a check. No, you need to be talking to 80 to 100 to 150 to get those 3 to 4 to 5 good checks.
If you want to close a $500,000, $750,000 pre-seed round,
yeah, they just
talk to a lot.
They underestimate how many conversations they have to have.
Yeah.
So,
but contrary to that, one of our portfolio companies went out to get a follow-on round, talked to 2 investors, and got more money at a higher valuation than expected. Why? Why did they get that? Because they were killing it.
Yeah. So there's a lot of things that go into that. But if this is your first money in, just expect to do more volume than you think.
A very famous entrepreneur here in Utah one time told me when he raised money and I congratulated him, he goes, yeah, that was our 41st
conversation.
Not just conversation, but in deep, more than just superficial conversation. 41st venture capital firm that they had to work with, and they finally got on the 41st one. Yeah.
Right. Okay. Let's another one here from this report. Again, we're looking at the state of pre-seed from Carta Q3 2025, and this talks about the dominance of safes. It's now absolute. The data here is 88 to 92% of all pre-seed rounds are using safes, and convertible notes have collapsed. Equity rounds have collapsed.
We know why convertible notes have collapsed.
Yeah.
Section 1202, the qualified small business stock exemption.
It doesn't qualify.
Really quickly for the listeners, there's an incredible tax incentive or
we've talked about it on this podcast a lot.
But a lot of people might be new listeners now. We've 6x'd our listeners and subscribers. And so basically qualified small business stock exemption, also known as Section 1202, means if you invest in an early stage startup or one of the founders' early stage startup, and it's a C corporation, and you actually own the stock and hold it for more than 5 years, there's incredible tax benefits. Right now, it's currently the first $15 million per shareholder would pay no tax at the federal level, and in most states, no tax at the state level. It's unbelievable benefit, and everybody wants to go for that. So convertible debt does not work. All the holding time of convertible debt does not count towards the 5-year holding period. And but actual stock does. And right now, safes are, the IRS has said, we reserve the right to change our mind later, but for right now, they're allowing safe holding period to be counted in that 5 years.
Yeah. And so safes are dominant and they're everywhere. And we understand that. We actually prefer and like equity rounds because it puts the founder...
Price rounds,
priced rounds, because it puts the founders and us as the VCs on the same side of the line. Yeah. And that's what we like to see. But at the same time, we understand that safes are dominating and that there's reasons why founders like them and why they're so founder friendly.
Yeah, they're just easy documents, and they are very pro-founder, pro-entrepreneur in a lot of ways. But at the same time, you need to also do your research. If you stack up too many of them, there can be problems that come from them.
Yeah.
But at the same time, we don't want to beat up anybody about that. And that's fantastic what they want to do.
And honestly, most founders are very flexible when we have that conversation. They say, oh yeah, safe or a priced round. Like honestly, to me, it's the same thing.
Yeah.
And because we just use simple equity terms and
so let's take
and documentation.
Since you brought that up, though, I think it's good for us to educate a little bit here. So let's talk about the major vehicles. Convertible note is a loan that has to be paid back or converted to equity.
It's a spectrum. Loan to equity.
Yeah, no, but it's a loan that there's a trigger event, just like a safe. Many of you know about safes. And it's just a loan, and it's going to get converted into equity at the next qualifying round. It's the exact same as safe. What a safe is basically like convertible debt, but it never has to be paid back in cash. And it could be triggered to convert to equity. And that's why right now the argument is that's more like equity than debt. So we're going to count it equity. It counts towards the qualified small business stock exemption holding period. And so that's safe in that. And then a price round, what we mean by that is you're actually selling to an investor actual stock, and they hold that stock right after they buy it, and they own that stock. Those are the major vehicles being used right now.
Yep.
And in pre-seed, it's early, and you go talk to friends and family and get some friends and family to invest. You can grab a safe document off the internet. The scary thing is a lot of people don't go to attorneys and they do this, right? And they just do it and they sign a safe, and that's a dangerous practice. We would never encourage you to do that without an attorney. But anyway,
I mean, and notes are still being used. It's just there's less, and honestly,
convertible notes.
And safes obviously dominate. And it does depend on the sector that you're in, right? The report goes over that only 32% of biotech are notes, which is much larger than the general overall pre-seed round.
Yeah.
But then in SaaS, it's only 5% are notes. So it depends on the industry and sector that you're operating in, what that market is used to and what they want to see and do. So it does depend on what vertical you're actually operating in.
There's more sophisticated investors in biotech because biotech's hard for investors to really grapple with and understand. And so they're going to tend to be more sophisticated investors. The more sophisticated investors, the reason they would do a price round, they want to get in and lock in that earlier price. The reason why a sophisticated investor would do debt is because they know that debt has superiority, meaning it gets paid back first before equity. And so they like the control position. That's just the way it is.
Right.
Okay.
Let's scroll down in the report. Keep going with us. Follow along if you'd like to. Pull up the report. We are going to look at graph number 7 now on the report. And graph number 7 goes on and talks about the geography of pre-seed, and that geography actually still matters.
Yes.
And that's because the West dominates pre-seed investing. Yeah. We know this. It's been around for 10, 15, 20 years. The West is around 50% of all cash in pre-seed versus, other geographical locations in the U.S. like the Northeast, which is New York and, Massachusetts.
Or the Great Lakes region or the South. Yeah.
Well, Midwest, the smallest, which is about roughly 5% of all cash in pre-seed deals. So, depending where you're geographically located, there's just more cash and there's more investment to
there's
obtain.
more gamblers in the West.
Yeah.
Because Nevada's out here in the West?
I guess.
Maybe so.
Even though Silicon Valley still drives pre-seed capital by a large amount.
And they're gamblers.
And where we're based here in Utah, we actually are doing a lot of investing and a lot of deals and a lot of startups per capita. We've talked about this before in the podcast, where we're based out of here in Salt Lake City and south of Salt Lake City in Utah Valley, Provo-Orem area. We have the most amount of startups per capita, more than anywhere in the country. We have the most amount of unicorns that have been birthed here per capita over anywhere in the country. And so I feel like geography does matter. Obviously, we're very biased because we're here and we can see it and feel it. Yeah. But at the same time, I do think Carta's data here shows that where you are, getting investment conversations, where you're located, where you're talking to VCs does matter.
Yes, of course. That's why an interesting footnote is we've been doing our boot camp for 10 years. And there's been times when people from other states, about a third of our boot camp participants are from outside Utah. And this last one was about 40%. And they come out here and they go, wow, there's a lot happening out in Utah, and they actually moved to Utah.
Yeah,
it's crazy.
Just some of the key stats on that, how we can demonstrate that, Silicon Valley is still king, is the Bay Area had $746.8 million in pre-seed.
Of that 900 some million, yeah.
And I can't remember.
There was like 900 some million.
Yeah, something like that. But now these numbers are not adding up. So I'll have to look at the graph again. But then it says followed by New York, then followed by Boston, then followed by LA, and then followed by DC. And again, it's what I was touting with Utah is per capita. Obviously, these massive metropolitan areas.
I don't know, is the 900 million right? Because let's go back. There's no doubt that friends and family and early stage investing from friends and family that's not tracked by anybody anywhere is the largest every year of the amount of money going into startups.
I don't know. Did I say 900 million? I did. If I did, that was wrong, or that was for another graph.
Or something else. I think that was wrong. But just to let you know,
these numbers just from the top 5 areas are well over $1 billion.
The amount of money for Series A and beyond venture capital compared to like seed and pre-seed and all that, it's the later stage you go, there's less overall dollars going in. Actually, right now, especially since 2014 and the advent of crowdfunding, we just don't know the numbers. I'm sure there's estimates out there, but the amount of early stage investing by friends and family, angel investors, that's not tracked by any good mechanism dwarfs all of the other investments.
Right.
I mean, there's just so much. I mean, only 3% of startups get venture capital.
Yeah. If you're raising and on the trail to raising, kudos to you. And we're trying to give tips here on how to best make that most efficient and how to do it efficiently and effectively. But at the same time, don't beat yourself up if you're actually having these conversations, because a lot of startups don't.
Hey, fellow general partner in our venture fund and partner in all things Startup Ignition, let me ask you this. Do you agree with this statement? We are actually more interested in anything than helping founders be successful and have good outcomes.
Yeah.
Second to that would be helping them get a great investment from venture capital.
Oh yeah, no,
Primary, we just want them to be successful.
Yep.
Second, they should get a good funding round if they need it and put it to good use. And then third would be us. Are we a great
fit
partner for you? Yeah.
Yep.
Okay. Yeah. Okay. I think that's how I look at it.
Speaking on those pre-seed sectors, and depending on your sector, if it's safe or convertible note or priced rounds, there's also a graph in this report from Carta that talks about the sectors that are dominating as far as getting the most capital thrown into them, and SaaS still dominates.
Yep.
Right. We can see on the graph here that 1.162 billion this year has gone into SaaS. Next is hardware, then healthcare, then biotech, and then crypto and Web3 is still prominent, but way below that of SaaS. And I just want to point that out because there's so much talk about, is SaaS still the king business model? Is it still worth investing in? Is SaaS dead? Is AI going to take over the reign of SaaS? And I think that's because this report is kind of combining AI and SaaS together, because AI, most of it is still actually SaaS and subscription model. So,
okay, can I be the old sage guy for a second? We have to remind everybody how this all works. When disruptions come along, they get overhyped and then they actually crash, and then they have to find their level of productivity in human society. This is a recognized pattern. The Gartner hype cycle is the name for it. You can look up Gartner hype cycle, maybe throw up a chart on it. But what happens, I can just tell you, fax machines were invented in the 1920s to 30s, and it took till the late 80s till they were in people's offices. The microwave oven was invented and working. It took 19 years before it was in people's kitchens. Every disruption to a major thing takes time and gets overinflated first, then crashes and does this. AI is going to be the same way. All these things. So, and you have to understand, there's still incredible things and opportunities to SaaSify or webify processes that are done either with paper and pencil or Excel. And yes, AI is going to be a part of it, wrapped in a SaaS container. And that's how I believe it's going to be for a good long time period. And that's just because that's how things evolve has gone, and things get overhyped and that they're going to crush things. When I was a Yellow Page print publisher, I was told 2 years from 1994 to 1996, the internet about 1994 where people started hearing about it. It wasn't until 96 that Netscape went public. But in 94, 95, people were saying, Yellow Pages will be gone in 2 years, dead, wiped out. It took, and they're still here, but it took 20 years before that was even semi-true, okay? Yeah. And so we have to realize this. So my point on this is like you and I have one of our latest investments in our fund, super excited. And I don't know if we want to share it, but I'm just going to tell you, in one of the biggest, most important things in all of human existence, one of the most important things of all, it's highly regulated, and all of the compliance and regulation around it and the participants in that ecosystem have been doing manual paper and pencil or Excel reports even today to comply with US federal requirements to participate in that industry. And we have a startup that is SaaSifying it. And how excited are we for that company?
So, but you're saying the point is that there's still industry that needs to be SaaSified.
Yes.
Yeah.
Yes. And it's amazing when we did our due diligence and called up customers and how much they said, oh my gosh, this is incredible.
It's life-changing.
Yeah. I'm just saying, those opportunities are out there. Entrepreneurs know that there's lots of money to be made taking paper and pencil and Excel spreadsheets and SaaSifying.
Yeah, and a lot of founders say that was 10, 15 years ago. No, it's still happening. We just invested in one. But I think this Carta data is cool because it really shows where the capital is flowing so that founders can really understand, the sectors that are still attractive to investors today, and SaaS is still king. But just know, if you are in SaaS, that also means that's the most competitive sector as well, that you are competing against a large amount of pre-seed opportunities. And so just make sure that you have a valuable opportunity and paint that picture very clear.
So you have to have a great idea, no doubt about that.
Yep.
But that's 1%, 99% execution. You have to be the founders that can take that great idea, that great product market fit, and all the validation work you've done, and now you've got to go execute. That's why we just can't look at the idea and the potential for product market fit. We have to look at, does that founding team have what it takes?
And just make sure your differentiation is crystal clear. So whatever it is that is different from all the other deals and opportunities, not just from your competitors and what you're doing, that has to obviously be there. But I'm saying do something different so that your SaaS deal is more attractive than another SaaS deal. Because a lot of founders, what they say is like, oh, come on, like just take this small little bet on us. Like we're looking for, $450K, $500K. It's like, I understand how attractive and what you're doing, but you got to understand, we see 2,000 deals a year, and we see a lot of opportunities, and to stick out, even just with our little old venture fund of 2,000 deals a year, you have to be doing something really, really special and really show the opportunity that's at stake and at play.
Yep.
Okay. I think this has been a great conversation. Go read the full report. I think we need to, you go analyze it, go look at it, so that if you're going to fundraise, you need to be aware of the market. You need to be aware of what's going on. You need to be educated in who you need to talk to, how you need to talk to them, and then you can shape your deal into one of those amazing opportunities that we talked about, so that you stand out and you actually get an investment. Any other things you want to talk about today from that report, or anything that stuck out to you?
No, I'm just going to, I think since we're talking about pre-seed and doing this report, Tyler, why do you and I stick with pre-seed? I've been venture investing for 30 plus years.
Oh, I said 25. Okay, 30.
Okay.
Yeah, I don't want to date you. You date yourself.
Okay, 25 to 30, whatever. Yeah, I'm okay. But, and all the people that, when we were doing angel investing and all that, which was pretty early and all that, very few of us stayed in that because it's rough and tumble and can be really risky. And it is risky.
Yeah.
And so most investors migrate to the later stages, which has to do with your geography. The East Coast, the Midwest, the South. We have Silicon Valley out here, and it's kind of spread out to the rest of the West, and so we're more taking gambles, but they're calculated risk. But there's a lot of low tolerance for risk in the other parts of the country, which is why it's different like that. And why have I stayed, and now you've come into it?
And stayed in pre-seed.
We have some good friends that have stayed in it, and we all do really well in pre-seed. You have to do it right and correctly, and you have to stick with it, and you have to know the game. You will get burned if you try to do pre-seed investing and don't know what you're doing. And an angel investor or a person that is just got a little money now, and they say, I want to get into early stage investing, you have to do a good number of them. You can't just put all your money into one or two companies and pray that they work out.
Yeah.
We have a whole strategy, very detailed on how we make pre-seed investing work and get outsized returns.
It's a very disciplined approach.
Yeah.
You have
when we
to
get
be
a return,
disciplined.
though, we're seeing 20, 40, 60 times our money coming back. But we also have a lot of failures, ones that totally lose all their money. But it works out in the end because we know what we're doing. And hopefully over the time, if you listen to this podcast, you'll pick up skills, not just how to be a good entrepreneur, but then the day when you want to start being an investor, how to do investing right, because that's happened to me. There's been about, I'd say, a good dozen in the last few years of people that got exited after all my mentoring, and they got success, then came back and said, hey, John, you also need to teach me about how to be a good early stage investor. Yeah. And that's the principles. I'm just warning people two ways. One,
the investment of pre-seed,
you better know what you're doing.
Yep.
And number two, it's an incredible place to play though when you know what you're doing.
Right.
Yeah.
Right. So, and I want to cap that with it's very disciplined. You have to stay very disciplined.
Yep.
And I think that was our kind of strategy.
And even us, sometimes we've caught ourselves not being disciplined enough.
Yeah, but I think that was our shining star moment when a lot of the VCs in 2020, 2021 were going hog wild.
Yeah.
We stayed disciplined and we're kind of seeing
no investments for 2 years.
Yeah, we're seeing the benefits from that.
So we plowed money in before 2021 and then rode that wave up, got exits. And then when everything crashed in 2022, we got back to plowing money into companies.
Yeah.
Yep.
Okay. I want to summarize this episode. Thank you for watching. I want to summarize though, that this Carta report in summary is that there's still a lot of capital out there and capital's not going away. And I think what we need to do is look at the flows into pre-seed specifically for these early stage entrepreneurs. But the capital is concentrated, the capital is disciplined, it's selective, and it's really tethered to real traction. I think that the overall trend we're seeing here is that pre-seed and founders and investors are becoming more capital efficient in the early stages.
What did I teach at our annual meeting earlier this week? I said, after pre-seed, by the way, at pre-seed, we're kind of buying into your vision. We are a little bit, right? Yeah. But after pre-seed, it's not about your vision. It's about your traction.
It's about metrics.
You better have growing revenue and low churn.
And what is a famous thought leader in the startup world, Ash Mora, say? He says the only metric that matters is traction.
Yeah.
When you get into the later stages, when you go seed A, B, all that matters to attract capital is traction.
Exactly.
So, okay.
All right.
Thank you for tuning in. Come hang out with us online. Come follow us on social media. Subscribe to our YouTube. Get the notifications. We appreciate all the support. You guys have been amazing, keeping us motivated to keep going and doing this podcast. It's almost been a year. We're going to complete a year here.
Is it really?
Next month.
What is this? Are we in the 30s on episodes? Yeah, this is, I want to say this is episode 38.
Wow.
Yeah. Okay. So we're getting there. And we're doing it because we're seeing
how many people are liking it.
Yeah, it's so fun. Yeah. Honestly, I think the coolest thing is even when I was building my own startups and people would come up to me and tell me how my product helped their life and everything. And, you
Still get that all the time.
and even as an investor, thank you so much for investing in me. If it wasn't for you and your mentorship, I wouldn't be where I was. But I think one of the coolest things that I get out in the wild is like, hey, I listened to your podcast. And I'm like, really? That blows my mind.
I'm getting calls from all over the country saying, everything you're saying resonates with me. I've been looking for a mentor or help like you. It's awesome.
Yeah, so it's this. We really appreciate you guys. We really appreciate everybody listening.
Tell your friends about it. Subscribe.
Yes.
Follow us.
So hopefully this episode helped clarify that state of pre-seed. And thank you so much for tuning in. And we are out.